We've got it set up here on this chart with global equities, commodities, global 60-40 portfolio, which is your average portfolio, 60% equities, 40% bonds, REITs, and then global bonds. And you can see from a global equity standpoint, not a bad year so far. But you can also see if the green is the second quarter and the blue is the year to date, that the year to date is much higher than, let's say, last quarter, which tells you what? Says that the first quarter was a pretty strong quarter and it kind of slowed down in the second quarter. But all in all, so far year to date, doing quite well. And think about it from a global equity standpoint. We're talking about global companies. And a lot of what's pushing the global companies right now is the US. It's kind of holding things up a little bit from the rest of the world. Commodities, pretty much a steady Eddie this year. Commodities are difficult to trade on. That's why we don't really have commodities in the portfolio. They're kind of like, well, they're commodities. They kind of do their own thing. And a lot less predictable for a long-term portfolio. I'm going to skip over the global, go to REITs. Everybody knows what REITs are. They're real estate investment trusts. Kind of think of it like a mutual fund with a bunch of properties in it. That's what a REIT is. But REITs tend to be non-liquid. You know, you get into them and the REIT company tells you when you can get out. And it's not something we really like all that well. Generally, because if the market's not doing something, we can make adjustments to get the returns out of it. But with a REIT, you just got to set it and forget it type thing. And that could be good or bad. And then global bonds. Global bonds, I think everybody's heard me talk about the fact that we're currently in a secular bear market for bonds. Now again, what is a secular market? Secular markets tend to last a decade, 2 decades, 3 decades, 4 decades, depending on which, whether you're talking about equities or bonds. So it is conceivable that we will be in a secular bear market for bonds really going on another 20, 25 years, which really kind of hurts the conservative investor, doesn't it? Yes. Because that's where most conservative people go. They'll go to bonds to kind of stabilize their portfolio. And that brings me back to the global 60-40 portfolio. If you look at the difference between the global equities and the returns on the global 60-40, you'll see there's a pretty big difference there, and it's all driven on the downside because of the bond markets right now. So you can see that when you think about it from a conservative standpoint, if you effectively want dividends, let's say, I mean, a lot of people get bonds because they want dividends, they want the income that comes out of it. 2 things I would say there. Number one, make sure that the dividend portfolio is in a qualified account, not non-qualified. The major reason is the tax structure, the way dividends get taxed and the way capital gains get taxed. The capital gains is much lower from a tax standpoint. So we try to stay away from dividend portfolios within a non-qualified account. It's not a good tax move effectively. But if you have them in an IRA or a Roth IRA, doesn't really matter. It's either going to be fully taxable or it's going to be fully tax-free. But the one thing I want you to understand when it comes to the bond market, if we are in a secular bear market, which we are, effectively you'll have a year where you're looking pretty good and then it's kind of retraced and then it comes back up again and it retraces. Kind of think of 2022. 2022, the bond market was down, right? 2023, the bond market was up. 2024, what's happening? Bond market's down again. So you're effectively walking sideways, and yes, you're collecting the dividends, and by the end, when you sell off, when that bond matures, you're going to get that full par value of the bond, plus whatever dividends that you accrued along the way. But what you would expect is that your portfolio will not perform as well in a traditional 60-40 portfolio.